In this presentation, we will discuss capital expenditures and revenue expenditures and the difference between the two, using a forklift as an example when we go through the demonstrations. So we have the capital expenditures and the revenue expenditures, and often the question is, should something be capitalized as a capital expenditure or should it be expensed as a revenue expenditure? In other words, what statement should the expenditure go under? If it is a capital expenditure, it's going to go on the balance sheet. If it's a revenue expenditure, it's going to go on the income statement. If we think about something like our forklift here, the question is, if we do some maintenance to the forklift, is it a capital expenditure? Is it something we should put on the balance sheet and then expense over time? Or is it something that we should expense in year one? Should we put it on the balance sheet as we do with the forklift itself and expense the cost over some useful life? Or should we put it on the income statement and just expense it as it happens? Now, of course, the difference between those would be if we capitalize the expenditure, something like putting a whole new engine in the forklift, for example, it would then go on the balance sheet. Whereas if we did some maintenance on the forklift, then we would put it on the income statement. And there's always going to be some question in terms of how much repairs and maintenance should be put on the balance sheet and how much should be just expensed at the time of purchase. So expense recognition then would be deferred if we're talking about a capital expenditure, meaning we're not going to write off the expense at the point in time we have the expenditure. If we put a whole new engine into the forklift, then we're going to put it on the books as an asset as we did with the forklift itself, and then expense it over its useful life, depreciate it over its useful life. And that means we're going to defer the expense and we're not going to lower net income in year one. It will be lowering net income in later years. Whereas if it's just a normal repair, then we can just write it off in this year. We can put it on the books as an expense on the income statement, recognize it, and decrease net income. Note the different objectives we might have depending on whether we're looking at it in terms of wanting to look good for our financial statements or in terms of taxes. So in terms of wanting to look good, we would probably want to put it on the books as a capital expenditure. And note that wanting to look good or not look good is not the reason for us putting it on one or the other. We're trying to make our financial statements as fair as possible. But sometimes it helps to look at some type of objectives that may be there in terms of how would we look better? How would we look worse? When would someone want to look better or worse? If we're talking about looking better to present our financial statements possibly for a loan or investment, we'd probably want it as a capital asset because then we'd have more assets and we wouldn't be decreasing net income at the point in time of purchase. If we wanted to look worse, probably for taxes, then we would want to recognize it as a revenue expenditure and expense it now, have basically a deduction, lowering net income, lowering therefore the taxes. maintenance,